Hi everyone, I'm here with Brendan Gilmore today. He's the MD of BPG Strategy, and you're like in the fintech kind of space and helping fintechs navigate the financial services space. You've got a financial services background. Brendan, thanks very much for joining me today. Really appreciate it.
No, delighted to be here. Delighted to be here. Yeah, and you're right. I spent 20 years as a banker, and the last 8 years I've been bridging the gap between old world and new world financial services. So it encompasses some of the old world and some of the new world and everything in between.
This kind of conversation came around because we were chatting about, I suppose, financial services and backgrounds in financial services, and
Yeah.
it can be like quite a complex kind of world and complex to navigate. And I suppose what we were chatting about was like, what are some of the drivers, I suppose, that you see? Because it can be difficult, particularly if you're trying to get your product out there, and there are different drivers that can be maybe different than you see elsewhere. So it'd be good to maybe just explain what are some of the drivers and challenges you see when you're out in the market.
Yes. So I think the first point you make about it being complex is probably the one to focus on first because it is vast. Like the financial services world, I always think of it in terms of the kind of the real economy and the financial services that serve those and the
Mm.
financial services economy. And if you think about the real economy, you've got all the banks and there's the big five, the established smaller ones, there's challengers, there's neo banks, and you got to think about them. Then there's all the non-banks, the specialist lenders, and there's lots of fintechs that are emerging at the moment that some people have never heard of, other people might be more familiar with. And then even within the banking space, you've got retail banks and commercial banks and corporate banks and wholesale. You can go on forever in the real economy. And that's before you think about the financial services economy that covers hedge funds and private equity and whatever. And that ignores insurance, pensions, wealth management. All of these different elements in financial services have different cultures, have different characteristics and opportunities and challenges. And so whoever is interacting with these, I think they need to understand where they're playing and the differences in that. Remember, it was an old boss of mine talked about 9 financial needs that everybody has, just if you focus on the retail side of it. And that's current accounts, credit cards, mortgages, insurance, pensions, and things like that. I can't remember the full 9. So before you even think about it, you've got where do I play? Where can I add value? What can I do? And the challenges will differ depending on the answer to those questions. And I guess there's in terms of things, the drivers that are going on, there's the macro issues that are always there. There's people who want to maintain the status quo. There's people who want to grow what they want to do, and there's others that want to do more of what the others do. So if you break down everything I've said before about the different constituents, what I think you see is an awful lot of people in, say, the fintech world, take a Monzo, who started out as a current account provider, but now also want to do pensions or also want to do home insurance. So they're all trying to figure out ways of doing a little bit more of what they do, and also how do they do things that others do.
Yeah, and I suppose if you just taking a step back, if you just look at the creditor side as an example, what are some of the products that they're asking? Because we hear a lot, for example, around AI at the moment, it's been out there, and that's like in the market and people talking about that. But when you actually talk with creditors and you talk about them having different needs, what are some of the things that are driving them that they're saying, well, this is a problem I've really got to solve? What is it they're asking? Or are they just like also then just reflecting what's in the market?
When you say creditors, what do you mean?
For example, the banks themselves, the
Yeah.
lenders.
Oh, so well, lenders, look, they all have, and this is one of the things why I exist in terms of translating between that old world and the new world. I think you've really got to, there's the standing issues they have. The status quo and the preservation of the status quo is a huge driver in a banker's day. So that could be 70, 80% of their annual kind of expended energy, let's call it that. But the challenges that are driving them is how do they make more net interest margin? So how do they make the spread between what they're lending at and what they're borrowing at different? And this is at exco level. They're all their challenges are how do they modernize, and that modernization could be in a just that end-to-end journey, making it quicker, making it more efficient, making it more effective for customers to engage with, because obviously that drives costs down and allows them to earn more. There's the world of customer expectations that are changing that they're having to adapt to. So all of the banks are grappling with that at the moment. There are table stakes out there that didn't exist before. So having a slick app is not a differentiator anymore. In fact, having an awful lot of these things is not a differentiator anymore. Everybody has the same level playing field of tech. It's just a question of where they are in that journey. They're all grappling with regulation. They're all grappling with compliance and the new issues that are coming down the track, whether the FCA is upping the ante on consumer duty. But there's this constant drive for continuous improvement. And I think that's what's on everybody's mind. But then there's emerging issues too. Everybody's worried about that point I'm making earlier about eating each other's lunches. Disintermediation has been around since I joined my banking career. In fact, when I started, I remember the guy who, my very first boss, talked about a few issues like that. And disintermediation was a bigger word than I I understood at the time, but I think 25, 30 years later, I now do understand what he means by that. AI, you touch on, you can't have a conversation anywhere in financial services without talking about AI at the moment. And I read during the week that Lloyd had sent all of their senior folk on AI training course. So they're trying to get it embedded at the top of the organization. So yeah, the issues are vast. They're many, they're varied, and it's a question of what people have time and resources to focus on, if that makes sense.
Yeah, and I suppose, do you find there's a difference between like large firms, like you talk about the large banks, the really large banks, and their ability to be able to turn and implement some of these ideas versus the smaller banks? You mentioned some of the like the challenger banks there as well. Is there?
Yeah.
And I know you, like, in your history, you've worked at some of both of those. How do you
Yeah.
find that characterize the difference between the two sort of cultures in a way?
And I'm simplifying, but within the large banks, you tend to have, they're much more sophisticated. They have the resources, they have the balance sheets to be able to experiment with things. And in their defense, which I rarely do, they have to be all things to all people. So they can't just implement something in a very narrow way. They have to think about it. How does it affect vulnerable customers? How does it affect? So they definitely think about things differently, but they have armies of people to implement that. If you look at the smaller banks, they're much more narrowly focused. So Starling clearly doesn't have to have an executive committee meeting about their branch network or how they're going to populate that because they don't have one. It means they're leaner, but it does add a bit of risk as well. So I think the mindset is different. With a large bank, they also look for modular solutions because they want to optimize one particular aspect of the customer journey. Maybe they want to make decision making or collections or whatever it is just 10% faster, and that has a huge impact. If you're a smaller challenger bank, and I don't mean the neobanks like a Starling or Monzo, I'm thinking of some of the others that sort of came behind, but more traditional ones. They want to improve their end-to-end journey. If you think of a small building society, so they want to modernize the whole thing. They're not just looking at it narrowly. So when you're trying to sell to them or when you're trying to explain a solution to them, you need to think about it in those terms. There's no point in bringing in the slickest KYC solution into a bank that hasn't, or a building society that hasn't really got away from paper or kind of PDF forms printed out and typed on. So there is definitely a different mindset. There's a different capability, there's different resources, there's different levels of sophistication, there's a different starting point. So absolutely, you have to think about them differently. But I think you have to think about the personnel in there differently as well, because fundamentally it comes down to personal relationships.
Yeah, and I suppose the challenge, particularly if you've got a great product, let's say a KYC product, and it's going to fit within one of the large banks, is just it can often take a long time to get people's attention, to get to talk to the right people, those kind of things. And I suppose
Yeah.
versus if it's a burning issue, I suppose then it becomes easier. What are some of the dynamics that you have to really get your product or get your what is often a fantastic solution for a business problem, get that kind of notice, because that can be a difference of challenge, it feels, as well, between large banks, which is like it's this big sort of monolith, versus somewhere
Yeah.
that's slightly smaller where you've got someone you can actually go and talk to.
Yeah, banks are curious beasts, which is no big revelation. But I think you've got to understand who the decision makers are as well. And it's that old adage of who uses, who chooses, who pays, who profits. But if you break it down, a lot of big decisions within banks will go to the exco, and that exco will consist of the CEO and the chief risk officer and the chief operating officer and some of the folk from the front line. You might have a chief people officer. And in some ways, you've got to kill all those 6, 7 birds with one stone. So my advice to people selling into banks is that they need to have a 1 or 2 pager, not a 20-page deck, because the 20-page deck, number one, won't be read, and number two, won't be shared. So you have to have a 1 or 2 pager that goes in to whoever you've had the first conversation with. And the crucial thing is that they're going, okay, I've spoken to Chris. I understand what he's trying to sell me here, but I need to get buy-in from my CTO, from my chief risk officer, from my chief operating officer. So I'm going to send this to them and almost get permission to have a conversation, a more kind of a focused conversation on this. If your 1 or 2 pager doesn't address the things that the CEO and the CRO want, like, so the CEO wants to say, does this change them? Does this save the institution? Does it bring it strategically further on? The chief risk officer was thinking, will this give me better visibility on the risks, or will this allow me to manage the risk better? The chief financial officer is going, will this save me money? The CTO will go, well, I end up on the front page of the newspaper because this is in the wrong code or doesn't have the right ISO certification.
Mm.
So it's a very difficult document to get. And that's the key, I think, depending on the type of institution and the people you're dealing with. You need to understand the problems from their perspective, their individual perspectives, their department perspectives. Again, that old adage about, sorry, I wrote you a long letter, I didn't have time to write a short one. Focusing on that 1 or 2 pager, I think, is really brilliant, because it allows them to say, I understand what Chris was trying to sell me, and I'm confident that if I send this to the CTO, he's not going to send it back and laugh at me. Or if I send it to the CRO, she's not going to say, but why haven't you considered X?
And where would you target? Because obviously, particularly in large organizations, there's multiple levels you can target. So you can spend a
Yeah.
lot of time in the collection space, and you can target obviously people within the collections operations as an example. You can draw like the head of the department, or the decision maker might be like the MD or the CRO or whatever it is. Where's best to target? Because each of those have slightly different kind of needs and wants in terms of what's driving them in their roles.
Yeah, again, this is another thing I always think about. If you think about whether it's collections or KYC or whatever it is, you go to the head of that department and say, I've got a piece of tech here that can save you a headcount of 10. That individual who's head of the department has spent 5 years, 10 years building a career, is now head of that department and is validated by those 10 people on a daily basis because they are, who they are. So if you go in and go, I'm going to wipe your division out, what are they thinking? They're thinking, oh, I'm next. Instead of selling it to them in the context of with KYC or with collections, we can help you focus on the top 20% of the edge cases, and we can let the piece of technology focus on the 80. So it's a very difficult conversation to sell it to them. That's why you need to go in at C-suite level and say, I can make a difference to this organization, because they're open to that sort of thinking. They're not just, ideally, they're not just focused on the status quo. Although a lot of bankers are. A lot of bankers are really just about, how do I avoid getting blamed? How do I hit my target? And it's amazing how much that mindset pervades everywhere. It's not something they're going to openly admit to you, but the status quo is a very, very powerful driver in the bank.
And I suppose the question is then, how do you break that status quo? And particularly if you're in a less attractive area, let's say, because we spend a lot of time in collections, often can be seen as being less attractive. How do you make
Yeah.
that relevant to more senior parts in the organization versus, for example, revenue generation, which is obviously a big driver, right? And so there's a lot of money and attention gets spent on that, but it's around getting investment for products that can really make a difference at the back end.
Yeah. You and I have talked about this before. I think the best way to sell improvements in collections is to talk about how that's a revenue generator or how that reduces the cost of customer acquisition.
Mm.
Because if you get somebody into the collection space and you treat them really well by either being ahead of it and telling them this could happen, make some changes to what you're doing, they'll be very, very positive about that. Whereas if the collections process involves phoning them on an hourly basis, shouting until they make a payment, the likelihood is you might get your money back, but you've lost the customer. And at the front end, you're paying whatever it is between £500 and £2,000 to acquire a new customer. So I would almost look at that from a operational efficiency perspective, or reducing your cost of customer acquisition, because you don't have to replace that customer. You've treated them well, they'll stick with you. So it's about selling it to them in the context that they understand. And this is where my background, because by accident I worked in most of the silos in banking. I understand how the risk people think. I understand how the frontline people think. I understand how the CFO thinks. And if you can express, and this is a problem a lot of technology companies make, in my view, is they go in and say, look at how whizzy our tech is. They don't go in and explain the solution from the context of the individual whose problem is being solved. What does it do for them? And you ask, like, when's the right time to go in? It can be event driven. So if a new CRO has been appointed, they want to make an impact. So that's a good time to go in. Or if the bank has had a problem, or usually if they've been fined with something, that's when they're open to fixing things. But while things are going along just fine, it's rare that you'll have somebody say, let's tear all this up and let's be really ambitious and replace all of our tech stack, because I think that's a good thing to do.
Yeah, so you're waiting, but you've got to have a marketing strategy to like be relevant for all the time while they're still waiting for that event to necessarily happen. Because the event, they hope the event doesn't happen, but at some
Yeah,
point it probably will by probability. But you've
yeah.
got to be out in the market talking about what your technology does. So when an event does happen in one of the prospects, then that's when you can say, look, we've got a solution for you.
Yeah, and look, you've hit the nail on the head there. I think you've got to be ready at all times, but you've also got to be open to communicating the solution that you have in different ways to the different people who make the decisions in banks. But yeah, again, I have this conversation with tech businesses all the time when they're saying, right, we want to project sales for the next 12 months. Who's in the pipeline? And pipelines are pretty useless. People engage when they want to engage, not when you'd like them to engage. It's not like you're selling something that is a good that kind of people consume on a weekly, monthly basis. It's something that they have to make a big decision and a big commitment to internally. And for a variety of reasons, that decision can be delayed, it can be speeded up, usually delayed, but it can be delayed. It can involve people that maybe didn't contemplate when you were going into the sales process. And banks move slowly, and they move slowly for a reason.
How do you react to the, often there could be a lot of sort of pressure put on around like how do we close the deal in terms of the pipelines and those kind of things. How do you think the
Yeah.
banks react to that? And what do you think the best strategy is that? Because obviously all businesses tend to have pressure because they want to try and meet revenue targets, they want to grow their product, they've got a fantastic product. But on the other hand, it might not be the right time as well. So you get a bit of a clash in terms of pressure from one side to like close deals versus pressure to not buy because it's not quite ready yet.
Yeah, look, I think the simple answer to that is you can't put pressure on it, because the moment you put pressure on it, they'll pull back and walk away, because there's a reason it's being delayed, and it's probably somebody's political capital inside in the bank that they need to expend in order to get something over the line, and it might not be the right time. They might have had something approved at Exco the previous month, and therefore they're not willing to push it again. There might be other factors that mean that it's not. They might be coming up to the end of a budget cycle and they're waiting for the next one. So I don't think you can put pressure on them. Look, what a lot of people do is discount. A lot of people will say, look, if you sign today, I'll get this for you. But even that, in the context of a larger organization, is not going to win the deal. It has to be the utility that your solution brings to that bank that makes the difference. And look, it depends on the driver as well. If somebody's just been fined because their collections process was found to be regulatory incompatible or whatever, then they'll be much more willing to engage with you. I think I always describe a lot of what I do as leading a lot of horses to water, but I can't make them drink. So you just have to have a lot of horses and a lot of watering holes and allow the probability of one of them landing to drive the business. There's no easy answer to that, though, unfortunately. I wish there was.
I suppose you have to be out there saying, look, there's a lot of water out there. When you're ready to drink and you're feeling thirsty, then we can kind of help with that. And I suppose not contacting people because it's been then been put off for 6 months, which can be almost like that could be a problem because you're making great contact with people and then you have nothing because there's nothing immediate. But actually, it might be just be a delay of 6 months.
Yeah, and there's a good reason why, just to stay in touch, not over the top, but keeping in touch with people when there's something interesting happening. There's no harm in that, just to stay relevant and front of mind. And actually, it depends on how you do that as well, because I find that over the last, it's evolved, where people don't respond to emails. And I think I'll send another one and see what happens. No, people, and nobody's ever written back to me and said, you've sent 3 emails now, stop sending emails. A lot of the time it's, oh, thanks, you've just reminded me and I'll get back to you. So I think you need to be a little bit persistent without being overly intrusive, if that makes sense as well.
And we talked a bit about the large banks in particular, and you got this continuum between there and all the way down to much smaller organizations. For a new startup, where do you recommend the best kind of place to start is? Because we spend a lot of time talking about large companies, and yeah, they're fantastic to get in there, and you've got a lot of users. There can be a lot of opportunity for people, but they're also seem to take a long time to actually get in. Where do you think the sort of that sweet spot is in terms of targeting products where you're going to get the response quicker, maybe get the launch quicker, but also get some experience and then be able to expand from there?
Yeah, look, again, there's a trade-off, because if you go too early, they won't have any kind of runway or cash to be able to spend on your product. And I've seen lending platforms who've decided that they're okay with that and that they'll target early stage businesses, and they may not be commercially lucrative in the first year, 2 years, but they realize that some of these new emerging lenders or emerging fintechs are going to be big at some point. And if you work with them, you get a little bit more validation and understanding of your product. And a sort of a relevant side issue here, I was talking to somebody about consumer duty recently and how the banks approach that and how fintechs approach that. And somebody made the point, very valid point, that fintechs don't fall foul of customer duty, because actually that's what they're set up to do: the right thing by the customer, to be transparent, to be all the things that, banks and building societies get pulled up on. So if you are a product that is modernizing, it's no harm for you to engage with some of those early stage businesses, because you will learn how to optimize your product for things like customer duty or other regulation, or even just the speed of execution that a customer needs. And that can then be copied and pasted when you engage with a bank who's woken up to the fact that they need to do the same thing.
Yeah.
So there's a trade-off about how commercially sound you are and how long you can support customers that may be not able to pay the sort of rates that you originally want, but you're going to learn from each other and grow together. Again, it's a tricky balance, but picking some winners within the emerging fintechs is probably quite smart.
Yeah. It does feel like there's a lot of holding your nerve that you've got to have in terms of being out there talking to lots of people, but holding your nerve that at some point things will come along, and that might be different times depending on the size of the business. But it can be quite difficult to hold your nerve, particularly if you don't have revenue coming in.
that's the point. Yeah, the market can stay irrational longer than you can stay solvent, isn't that the other old adage? And I think that's true in this case. But the other thing is banks and building societies hunt in packs. So once you get one over the line, having that logo, having somebody else gone through it really helps, because then you can start to knock on other doors about, look, we're already live with these guys. And a bank, before Christmas, I was chatting to a bank and they said something that I used it in one of the conferences I was moderating at, that they wanted to be first to be third.
Mm.
And it makes absolute sense for banks. So they don't want to be the first to use a new technology. They don't want to be second. They want at least two others to have used it before they'll adapt it. Now, not everybody can take that approach. Somebody has to be first. But actually, it just highlights the fact that banks sit back and they wait and they see, does this work for other people? What's the impact been? What's the fallout been? What can we learn from it? And if all of those things look positive, then they'll jump in. So collection software, whatever it happens to be, if you have some reference cases, then I think the patience in waiting for that to land will pay off, because you can start to market that a lot more aggressively than to others.
The other thing you see sometimes is, particularly with the really largest banks, is we say, well, they don't have this technology or they don't have this particular product. But the really large banks can just go out and buy the company as well. That occasionally sometimes, particularly with portfolios, like automated
Yeah,
portfolios, those kind of things. And there are a couple in the past that I know they've seen, and they like then get absorbed into the mothership to a certain extent. I mean, that can happen as well.
again, people would say that it's easier to get acquired than it is to go through procurement, and that is
Mm.
the case. But it is an option, but clearly that reduces your ability to grow your company and to build out and sign up new clients. But strategic investment from some of the banks is useful as well. So you see that with Barclays and Lloyds taking 20% of a particular company, because they want not only to use the product, but they want to control the destiny of that and shape it towards what they're doing. So yeah, it is a strategy, but clearly it limits your upside. That's what you're in the business
Yeah.
to
And so
try and generate.
they're specifically talking about, I suppose, the fintech kind of accelerator programs, whether they've got that as well, right? They're probably
Yeah.
worth looking at.
Yeah, interestingly, NatWest announced a strategic investment in Yonder, the credit card business, this week. That's the sort of thing where Yonder have come out with a new approach where it seems that lots of people like their offers. I think it's very hard to crack that, add an offer into your product and people will stay loyal to you. I don't know how many products I have with bits of loyalty in them, and I just don't have time to go and scan them, to be honest. But Yonder seem to have nailed that. But instead of them having to build on their own 2 feet, NatWest are now there, and then suddenly they've got a huge array of customers, which
Mm.
to whom they can offer this new product without NatWest having to start up its existing card program. So they're obviously going to expand that out. But equally, there's a lot of things in NatWest that they've tried with Bow and with May loans and things like that, where they've learned from it and then just let them wither and die. Banks don't always get it right either.
Yeah. I mean, we talk about acquisition there or taking part shares. The other trend you see is a lot of partnerships. We're building up this almost like ecosystem between separate companies. So,
Yeah.
for example, you'll have a collection system, might have suppliers they work with or they partner with to do certain features maybe they can't build quick enough. And that's in some ways that's also taking place even with the vendor world with the banks as well. How much do you think that's going to grow? And then I suppose there are challenges managing the complexity of that as well.
Yeah, it is growing, and I think everybody is relying what everybody else does to sell. So if you've got a core banking platform and you're going to go in and try and rip and replace a core banking platform in a bank or a building society, if you don't have pre-integrated lending decisioning or workflows or KYC or whatever, you're making it the bank's problem. Whereas if you can land and say, we're already pre-integrated with all these credit scoring
Mm.
agencies with this kind of software, it helps the sell. So it's incumbent then on everybody in the ecosystem almost to have that relationship with each other, which is something else that I'd help with, because I almost encourage people to be as promiscuous as possible with their partnerships, because I think you need to be in bed with everybody if you want to succeed. Otherwise, you'll get left behind. Because what happens is you'll go to the bank and say, we've got a pre-integration with Experian, and they'll say, but we've got a long-term contract with Equifax. If you can't say, oh, we're already pre-integrated with Equifax, you could lose that deal, even though you are solving the problem that they set out to solve. So you need to have all of those things. The ecosystem is really important for those big sales.
Yeah, interesting. And I suppose if you were looking at hot topics that there are now, as you're outside talking particularly to lenders, what do you think the 4 or 5 really hot topics are that sort of are driving interest in the market? The ones that are saying that we've got to look at this in particular, because it can be a little bit fickle, but it's also,
Yeah,
it does drive activity.
there's so many things that they can do that I don't know. It depends on who you're speaking to and what day of the week. The thing that is obviously consistent now that nobody can hide and nobody can move away is all the work being done assessing the impact of what's going on in the US, and
Mm.
that's just overtaken everything else. And a number of people have said that, oh, I've had a lot of work created for me in the last couple of weeks because they're having to do an impact assessment on their lending books or whatever their kind of their focus is, their exposure is to the US. So you get things like that come in and derail absolutely everything else. But actually, the issues are driven by, and there's a consultancy that I've done work with called the Foundation. They talk about the burningness. Is it pain that people are reacting to? Is it fear they're reacting to? Or does somebody have ambition? So it really does depend what it is that's driving people's desire to change. So I think that whole modernization agenda is on everybody's mind. And as I said earlier, whether that's modular or whether it's full end to end is really relevant. I think keeping up with customer expectations is also there, and that's tied in with modernization, but it's also tied in with the image and the culture of the institution. I think ensuring that everybody is regulatory compliant is huge as well, and that's what focuses the board's mind because it's so expensive. You can't get away from AI. I think the problem with AI is that nobody really knows how this is all going to land. Like, it's almost everything has been thrown up in the air. What will the implications be? What will actually be useful? What will be safe? So that is one of the big drivers. And I think every single vendor that I speak to at the moment is inserting AI or machine learning into whatever pitch deck they have, notwithstanding the fact that banks have been doing it for 20 years anyway, but they have to put that in there, otherwise they don't get through the door. I think that the emergence of fintechs has taught people an awful lot about what's possible. And I think things like open banking, which is, we're still scratching the surface there, I think it's shown the way, and people are trying to find ways of implementing that. In the proponents of it would say it's quicker, it's cheaper, it's safer than cards. It just needs more adoption. But I don't know about you, but I'm seeing more and more adoption myself. If I pay a credit card bill, if you pay a tax bill, it's there. That's definitely something that can be exploited more. And it can be exploited more by AI as well. Because if you say, and I think this will have a fundamental impact on banking, by the way, if you tell your AI bot to optimize what you have in your current account and they use open banking to move money from one account to another, the free money that the big banks have at the moment in your current account will no longer be free because you'll have whipped it out and put it into a savings account and set a bot to say, please take that money out of the savings account the day before my mortgage payment is due. And they'll do that. So the bank's funding structure will change. I think some of the things that I've seen recently, AI for credit applications has become quite a topic. So lots of companies are out there now saying, instead of you having an analyst sitting there analyzing a set of accounts and analyzing reports on a company and looking at their bank accounts, we can get an AI bot to do that to you and present up a credit application as if an analyst had done it. And that can be from an onboarding. There was a demo I saw of a company recently where a broker sends an email in saying, I'm looking to buy a £400,000 house, I'd like a mortgage, or whatever. And they scrape what they can out of an email and present it back with just the bot does this, so there's no human involved. And the bot goes back and says, I need your full name and address, I need your national insurance number, I need the address of the house. And this just becomes an iterative process until all the information is there and then a decision in principle is issued. What else? Embedded lending, probably no surprise there, where people are being offered credit at the point where they're using the product. I think that's really useful and it's growing. And that's beyond the kind of the Klarna and the buy now, pay later side of things. There's other use cases of that, particularly in B2B now, where somebody has a big purchase. And instead of having to step out of that journey and say, I need to go and borrow a term loan from my bank so that I can afford this particular piece of equipment, you're pressing a couple of buttons and the funding is provided directly on the basis in which you can use it. So that's occupying banks' minds because they're seeing themselves disintermediated. So increasingly, they want to do those partnerships directly with the companies that have the consumers' eyeballs and activity and engagement on a daily basis.
Yeah, it's a hugely dynamic area, and I'm just going back to some of the turmoil we've got in the market at the moment.
Yeah.
I mean, that sort of stuff, these moments come along every so often, and that kind of things can change on a dime to a certain extent. And so if we're sitting here today before, maybe it'll change, maybe it won't, but what should people get ready for today, having seen these things before, to make sure that they're prepared for something that might come in the future? What can be done today? I mean, you talked about stress testing and some of the stuff where people are getting ready. What else should people be thinking about?
Look, we're in an age of turbulence, and I don't think that's going away. And I think that just there is a bit of a problem because over the last, let's call it 20 years, 25 years, the emergence of private equity and hedge funds squeezing every last pip and financially engineering everything to within an inch of its life has left no fat within a lot of these organizations. And I think that's problematic because they break very easily. So I think, and again, I go back to the crash. I remember one of the CEOs of the banks saying, I make a steady profit 5 years out of 5. The companies that seem to be rewarded and being valued are the ones that have extraordinary profits 4 years out of 5, and then they blow it up in year 5. So they're not being rewarded for that prudence. I think banks need to be thinking about that prudence and building in the flexibility, the adaptability to react to changes like this. That might mean that they don't look as optimized as possible in terms of from a financial reporting perspective. But I think you need to be prepared for that. You need to make sure your data is in the right place. You need to make sure your data is accessible and interrogable so that you can react to this. How much exposure do I have to US exports at the moment? Most banks probably can't answer that with a touch of one button. What that means is you say, who are we lending to? How many of them are exporters? What's the percentage of their sales as exports to the US? What will be impacted by those tariffs? Now, what typically happens in a bank is emails go out to every relationship manager in the country who are also trying to hit their targets to say, I want to report on your portfolio, which breaks this down. Now, in most cases, that's a manual process and there'll be spreadsheets produced, and somebody somewhere will come up with a grading to say, are you A, B, or C exposed to this? Reminds me of Y2K when we had to do that on our companies, and it was just such a ridiculous exercise, but had to be done. But you need to have the flexibility and the technology to be able to do that, because in theory, you could press a button and get a report from all of your borrowers' accounting systems that showed how many invoices actually have we got, who are we exposed to, which buyers aggregated. So I've given you a long-winded answer there, but I think you need to be prepared for this turbulence, and plenty of it in the next few, particularly next
and particularly, I suppose, the rate of change. These shocks are very hard to plan for, but they can be fundamental changing in terms of, I suppose, business models to a certain extent, or some of the business dynamics. And you've got to be. But I think the other thing that's happening this time around is it's changing regularly as well. So what you might plan for might take a week, let's say, to get responses to the emails, that actually might change again within a week. And I suppose it's about having resilient processes and systems that can have that flexibility adapted in, I think, going forward.
Yeah, and that comes with the technology that you've deployed across the bank to be able to gather that information. Again, AI will help taking that unstructured data and making it structured, and giving you something to make insights of. The problem with a lot of the banks is that data is, they don't know where it is, and they don't really know how well it's recorded, and they can't really rely on it. So there's an awful lot of cleansing that may be done. But yeah, continuing to be able to plan for those contingencies, I think, and react to those contingencies is crucial. But nobody's going to be rewarded for building up a war chest to react, or to having an extra crack team of operatives to react to something, because everybody will be wondering, what are they doing and why are they getting paid so well? But yeah, they are tricky times, because we really don't know what's going to happen tomorrow, never mind in the next 6 months. And that's impossible for a bank to plan around interest rates and what they're going to charge on mortgages and house prices and things like that.
Yeah. So, Brendan, if I was going to put you on the spot and get out your crystal ball, and I know we just talked about the future, where do you think we're going? I suppose in 3 or 5 years, notwithstanding our comments we've just had now around where things can change on a knife edge, but all things being equal, where do you think that the technology world, in particular, and banking world, is kind of going?
So it might be more than 3 to 5 years, and if it is 3 to 5 years, then we might have a problem. But I think what's clear to me now is that, well, look, everything in financial services is about information asymmetry. Okay, something that I don't, and that's why I'm paying you to be able to help me to get a mortgage or invest or whatever. In theory, AI gives everybody access to perfect information. And I think that will create huge issues for banking. Because if you think about a mortgage, the seller of the house, sorry, the buyer of the house will know everything about the house, because it will all be linked by API, and you'll know the EPC rating, you'll know about the price movements, you'll know about the ownership, you'll be able to validate who owns it. The lender will know everything about the individual, because when you go and apply for the mortgage, they'll push a button, and all of the information about your bank accounts and your history and your salary and everything like that will be API-able. And the seller of the house will know everything about the buyer as well. So what is a customer journey at the moment, where the seller says, I'm going to sell the house, and then the buyer says, I'd like to buy a house, and goes to the mortgage company and then asks, can I get the money? And then they go, or they buy the house and they go around in the circle. That will all condense. So what happens to the process in the middle? So if everybody has perfect information, then there's an awful lot of financial services that is based on that asymmetry of information that will disappear. Now, I think so. So models are going to have to adjust to that. That sounds quite profound, and I haven't thought it fully through, so I don't know actually if it is very profound. But that I do think people need to really think about, because, and tied in with my open banking point earlier, if you can really optimize your finances by having a bot do it for you, because most people don't optimize their finances because they're just too busy doing other things. And you and I talk about financial services because that's our life and our job. But if you broaden it out to your friends, they'll probably yawn, and they probably won't bother making sure they can get a current account that has 0.3% more interest on it because they want to watch Netflix and they want to go to the park or go to watch football. If you have a bot that does that, then that genuinely does change the financial services model and the premium or the margin they're able to charge for what they do. Because a lot of what they generate margin on is inertia. And if that inertia is removed, then I think the model has to change. So is that a good enough answer for an on the spot?
Yeah, two things you're making me think of there is one is, I suppose, is it velocity of money, and that can help in terms of, say, things like economic growth, and because you're shortening the time frame now, how quickly money can be used and the efficiency around money can be used, which is an economic piece. The other piece I think you're talking about there is that banks are going to get squeezed on margins, it sounds. So that whole piece around coming back to the fintech piece, which is how do you then have efficient processes, make sure they can facilitate some of these transactions in a much more efficient way for them to still keep their margin. Otherwise, there's pressure, isn't there?
Yeah, oh no, absolutely. And while big banks have an awful lot of free funding through their current accounts, if that disappears, then they're going to have to find another way to compete.
Yeah, yeah.
And the reason that fintechs win at the moment is because they're slicker and they're quicker and they're easier to deal with than the big banks. So they're going to have to adopt that. And maybe circling back to your point earlier, they're going to have to acquire them. So there might be some M&A activity out there. But I do think we're in for some fairly fundamental shifts.
Yeah, it's an interesting space to watch. Very interesting in terms of, I suppose, the whole dynamics around how do you get in to help some of these companies as well. I think is just fascinating in terms of the psychology. And I do think that your advice there around being a little bit patient, but then also that having the conversations with people on the inside and understanding what's driving them, I think was particularly important. Brendan, thanks very much for joining me. I really appreciate you making the time.
No problem. Delighted to do it. Thanks, Chris.